fund by an employer in excess of 12% and interest in excess of 9.5%. Then the aggregate of all sums comprised in transferred balance, then contribution made by the government or any other employer to a pension fund to the account of the employee in a pension scheme notified by the central government. Suppose there is a pension scheme notified by the central government and any contribution made by the government or any other employer in the previous year to the account of an employer under a pension scheme, that shall also be included. So all these are included under the head salary. Now, very often a question is asked, what is transferred balance? Transferred balance means where an unrecognized provident fund is recognized for the first time, the balance standing to the credit of the employee in the unrecognized provident fund. That is what you call as transferred balance. When an unrecognized provident fund is converted to recognized provident fund, the balance standing to the credit of the employee in the unrecognized provident fund. That balance includes contribution by the employer, contribution by the employee, then interest on both employee's contribution and employee's contribution. That is the balance in the unrecognized provident fund. What is taxable portion? The taxable portion of the transferred balance is employee's contribution and interest on employee's contribution. That shall be included under the head salary, and interest on employee's contribution that shall be chargeable under the head income from other sources. Now, there are different forms of salary. Let us see what are the different forms of salary. Different forms of salary means leave salary, compensation for retrenchment, fees and commission, then death come retirement gratuity, commutation pension, receipts, etc. Then pension received, voluntary retirement, compensation on voluntary retirement, etc. That we can see later. Now, we have to, before going into details, we have to classify the benefits given by an employer to employee under two headings. One is allowances and perquisites. First we can see allowances, then we can go to perquisites. What do you mean by allowances? Payments in cash made by the employer to his employees. Any payment made in cash other than salary, that comes under allowances. So, payments made by the employer to the employee other than salary in cash, that comes under allowances. It may be a fixed sum paid regularly in addition to salary. The purpose may be to meet some particular expenditure requirement connected with the services rendered. Allowances are usually given to meet the requirements in connection with the employment. What's the difference between perquisite and allowances given in cash, that comes under any payment given in cash, that comes under allowances. When benefits given in kind, that comes under perquisites. Allowances are classified into three categories. One is taxable allowance, then allowances exempted up to a specified limit, then fully exempted allowances. Allowances we can study under three categories: fully taxable, exempted up to a specified limit, and fully exempted allowances. Let us first see which are taxable allowances. Dearness allowance and additional DA. DA or dearness allowance, that is that is given by the employer to employee to meet the high cost of living index, to compensate on account of high prices. DA may be called, sometimes it may be called as an additional DA allowance. Whether it is called DA, dearness allowance, or additional DA allowance, it is included under the head income from salary. DA may be given under terms of employment or it may be otherwise. Whatever it be, it is always included in salary. Next is dearness pay. When a whole or a part of the dearness allowance may be converted to dearness pay, then it becomes part of salary. When a pay revision comes in the case of government employees, a part of the DA or a part of the DA may be converted to basic salary, that is dearness pay. Now I am dealing with the fully taxable allowances. We have seen dearness allowance, additional dearness allowance, then comes dearness pay. Now comes fixed medical allowance. Fixed medical allowance means whether the employee is incurring any expenditure on treatment or not, whether he is purchasing medicines or not, he is given a fixed sum every month. No doubt it is fully taxable. It is fully taxable. Then comes tiffin allowance. Tiffin allowance is fully taxable. It is given for lunch and refreshment of employees. For meeting the expenses in connection with the lunch and refreshment of the employee, this tiffin allowance is given. It has got other names also: meal allowance, refreshment allowance. By whatever name you call, that allowance is fully taxable. Then servant allowance. Servant allowance is given to, it may be given to high paid employees and low paid employees. Where even if it is paid to low paid employees, it is fully taxable. It is fully taxable for all. Servant allowance is fully taxable for. Then non-practicing allowance. This is given to doctors who are not allowed to practice. Now, in certain states, medical doctors are not allowed to practice. Then they will be given non-practicing allowance. That is, it is fully taxable. Then comes hill allowance. Hill allowance is given to employees who are working in hilly areas. This is given because the cost of living in high hilly areas may be more than the cost of living in plains. This hilly allowance is fully taxable provided the place is located at less than 1,000 meters height from the sea level. That point you have to remember. If the place is located at less than 1,000 meters from the sea level, that hill allowance given to employees, that is fully taxable. Otherwise, there is exemption that we can see later. Then warden allowance or proctor allowance. This allowance is given in educational institutions for employees who are working as wardens of the hostel or working as a proctor in the institution. This warden allowance or proctor allowance given, this is connected with the education institutions, that is, people who are working as wardens or proctor in the institution, warden, the hostel, proctor in the institution, they will be given an allowance, that is warden allowance or proctor allowance, that is fully taxable. Then deputation allowance. A deputation allowance is given when an employee goes from his usual place of employment to another place in connection with services. Suppose an employee has to work at some other place, not at the usual place, that is not transfer. But he is given an additional duty to work some other place, then he will be given an allowance that is called deputation allowance. That's only for a temporary period. No doubt it is fully taxable. Then overtime allowance. When an employee works overtime or extra hours, he is given overtime allowance that is also fully taxable. Then comes certain allowances, family allowance. Now we have to deal with allowances which are exempted up to a specified limit. We have seen allowances which are fully taxable, allowances which are fully exempted. Now allowances which are exempted up to a specified limit. Let us see allowances exempted up to a specified limit. Here the most important one, and one which we have to study with regard to allowances exempted up to specified limit, is HRA. HRA, or it is also called a house rent allowances. House rent allowance. Let us see what is house rent allowance. Allowance given by the employer to the employee to meet the expenditure incurred in connection with payment of rent in respect of residential accommodation occupied by him is exempt from tax to a certain. That is, HRA is given by the employer to the employee to compensate for the high rent prevailing in the locality. Suppose an employee is not having any rented accommodation, he is not having his own accommodation, or he is not having his own house, then he may take a house on rent, or he may take a house on lease. For that, the employer may give an allowance to the employee. Employer may give an allowance to the assessee. That allowance is exempt to a specified limit. It is not fully exempted, but it is exempted to a specified limit. Rule 2A specifies how much is the exempted amount. There are three clauses given. Actual HRA received by the employee. The least of the following. There are three clauses given, out of which the least shall be exempted and the balance shall be chargeable to tax. Now let us see what about that. Actual HRA received by the employee. A. Least of the following exempted. Least of the following exempted. One is actual HRA received. Actual HRA received. Actual HRA. Actual HRA received. B. Excess of rent paid over 1/10 of the salary due to the assessee in the relevant period. Excess of rent paid by the assessee over 1/10 of salary. That is, rent paid minus 1/10 or 10% of salary due to the assessee in the relevant period. In the relevant period. C. 1/2 of salary due to the assessee if the accommodation is located in Delhi, Mumbai, Kolkata or Chennai. If the accommodation is situated at any other place, it is 2/5 of the salary due to the assessee. C. 1/2 of salary. 1/2 of salary due to the assessee. 1/2 of salary due to the assessee if the accommodation is situated in 4 big cities. Accommodation in Mumbai, Delhi, Kolkata, Chennai. Then, if the accommodation is in some other place, C, accommodation at other places, 2/5 of salary due to the assessee. Yes, I shall sum up. What is HRA? HRA is an allowance given by the employer to the assessee or the employee in order to compensate for the high rent prevailing in the area. Out of HRA received, it is not fully exempted from tax. A part of the HRA will be exempted from tax. Then how much is the HRA exempted from tax? There are 3 clauses given. The least of the 3 shall be exempted from actual HRA, and only which are the 3 clauses? First one is actual HRA received. Second is rent paid in the relevant period minus 10% of salary due to the assessee. Rent paid minus 10% of salary due to the assessee in the relevant period. And the third one is, it is given as if it is in 4 big cities, it is 50% of salary or 1/2 of salary due to the assessee, 1/2 of salary due to the assessee, and if it is at other places, it is 2/5 or 50% of salary and 40% of salary due to the assessee in the relevant period. In relevant period, one important point is you have to remember is assessee can claim exemption for HRA only if the assessee is living in a rented house. Suppose the assessee is living in his own house, or he is living in a house for which he is not paying rent, then the full amount of HRA will be taxable. That point you have to remember. Suppose an assessee is living with his parents. He is not having any house, but he is living with his relative or his parents, and he is receiving HRA, it will be fully taxable. So, what are the 3 situations? Rule 2A specifies that the least of the 3 shall be exempted, that is actual HRA received. Second point is rent paid minus 10% of salary due to the assessee in the relevant period. I shall explain what is relevant period, that I shall explain later. And suppose the accommodation is situated in 4 big cities, that is Bombay, Calcutta, Delhi and Chennai. It is 50% of salary, and at some other place it is 40% of salary. That shall be. What is salary for that? You may see it is 10% of salary, 50% of salary, then 40%. What is salary? What is the definition of salary? Salary includes DA only if provided under terms of employment. That means if it is only included for retirement benefits. Salary means salary plus DA if provided under terms of employment, plus DP, plus commission paid on a fixed percentage of turnover. Commission paid on a fixed percentage of turnover means turnover achieved by the assessee. Suppose commission is 3% of the sales made by him. That is commission on a fixed percentage of turnover. So what is salary for the purpose of HRA? Salary here, definition of salary for HRA is, salary for HRA is basic salary plus DA under terms of employment plus DP, dearness pay, plus commission on a fixed percentage of turnover. Commission on a fixed percentage of turnover. This is salary for the purpose of HRA. Another point I want to tell you, that is, what do you mean by relevant period? Relevant period means 10% of salary due to the assessee in the relevant period, or if the accommodation is situated in salary due to. Relevant period means the period for which the accommodation was occupied by the assessee during the previous year. Suppose a rented accommodation was occupied by the assessee from June to November. June to November. June, July, August, September, October, November, for 6 months. Then relevant period is that 6 months. Then salary for that 6 months shall be only taken into account for the period from June to November. But relevant period means the period for which the accommodation was occupied. It means that salary of the period during which the accommodation is not occupied by the will be. That is, accommodation is not occupied for April, May, then December, January, February, March. The salary for that period shall not be considered. The relevant period, the importance of relevant period is salary for the period for which the accommodation was occupied by the assessee. That shall be taken into account. Now we have to work out problems from this. How will you so what about this is one of the most important allowance, partially exempt allowance which you have to study. What is HRA? HRA means an allowance given by the employer to the employee to compensate for the high rent prevailing in the locality. High rent prevailing in the locality. This HRA is exempted to a certain limit. One important condition for getting exemption for HRA is assessee should live in a rented house. If he is living in a house owned by him, or he is living at a place without paying rent, he is not eligible for getting exemption. That means HRA received by him will be fully taxable if he is not occupying a house without paying rent. Then Rule 2A specify what is exempted. Actual HRA received by the assessee. Actual HRA received by the assessee. Second clause is rent paid minus 10% of salary due to the assessee in the relevant period. Rent paid. Rent paid means if the accommodation is occupied only for 4 months, 4 months rent. Then salary for that 4 months period, that will be taken into account. Rent paid minus 10% of salary due to assessee in the relevant period. Then third point is, if the accommodation is situated in 4 big cities, it is 50% of salary, and if it is at other places, it is 40% of salary, or half of salary and 2/5 of salary. What is salary for the purpose of HRA? Salary for the purpose of HRA is basic pay plus DA if provided under terms of employment plus DP plus commission paid on a fixed percentage of turnover. Relevant period means the period for which the said accommodation was occupied by the assessee during the previous year. That is, when you take the salary, you shall take the salary only for the period for which the accommodation was occupied by the assessee, and not the salary for the period not occupied by the assessee, that shall not be included. Now let us work out a problem from this. I shall write the problem on the board, then we can work out. Find out the amount of HRA. Find out the amount of house rent allowance, which shall be included in the income under the head salaries in each of the following cases. A. Basic pay rupees 7,000 per month. DA at 10% of basic pay. Commission pay based on a fixed percentage of turnover, rupees 12,000 for the whole year. HRA rupees 2,000 per month. Actual rent paid by the assessee, rupees 1,600 per month.